if we just get chatting, David, if that's okay.
Yeah, fine.
As you know, I sent you some of the questions earlier that basically we're going to be going through, and as I'm sure you're probably getting the same questions as we're getting at the moment, which are revolving around the long-term effects of COVID. This idea that people are moving out of the cities and moving into bigger houses in the country. Is that permanent? How long is it going to last for? And is it going to impact the UK buy-to-let market, as in, for us as investors, and Brexit, all of this sort of stuff? So it's the same sort of questions we're getting. Are we seeing shifts in the market? Where the new opportunity is going to be? It's all that sort of stuff. So I think what we'll do, if it's okay, is, we'll just go through some of those FAQs that we're getting off people. And then if you guys can tell us a bit about sort of what you're doing, perhaps how you're adapting to that and some of the opportunities you're bringing to investors. And then we'll open up and do some questions for everyone that's listening. Hello. There's a chat box or a question box down at the bottom there that you can put questions in if you want to ask questions as we're chatting away. But just to introduce briefly, my name is Callum Williamson. I'm from APW today, this afternoon, this morning, this evening, wherever you are. Wherever you are in the world, as you'll see the world map behind me. Hello, we are speaking to Prosperity Property, who are, a large UK developer. They're based out of Birmingham. I'd say they're probably one of the Midlands' biggest developers at the moment in the UK, and they're also the pioneers of the 24-month payment plan, which is where you pay a deposit for an off-plan property over 24 months, so you don't need a massive deposit to get going. This is David Yellerley. David, thank you very much for joining us. How are you?
Very good, thank you. And thank you for everyone who's dialed in to listen to us, wherever you are in the world.
Thank you. Yeah, and hopefully we'll be having to answer some of those questions that we're getting asked from people, and picking your brains and getting an insight into some of your expertise on all of these sort of things. So, David, can you just give us a little bit of an intro to, sorry, just to rewind again, we've got, as usual, I think we had 107 people signed up for this, so it's our biggest yet. And again, we've got a mix of existing clients, people that are familiar with you guys, and then people that don't know you from Adam. So could you just perhaps give us just a little bit of a hello from yourself and a bit of info on Prosperity and what you guys do?
Yes, sure. Well, Prosperity are a UK-based developer based in Birmingham. We have numerous projects, primarily in the buy-to-let apartment sector. I think we've completed over 40 projects now, and at the moment we've probably got 10 underway at various stages of construction. We've sold well over 4,000 apartments over the last 8 or 9 years. So a relatively substantial business. Well-founded. The founder is a gentleman called Joe Billingham, who is intending to be on this call, but
stuck in traffic.
Stuck in traffic. I think might just be a useful comment to throw in there at the start, kind of indicating that we are UK limited, is still busy and active, and there are traffic jams out there, which does show that we are still going to work despite what,
contrary to what we're being told over here, or
suggest is happening in places like Singapore or Hong Kong. So yeah, so we have projects as far north, for those of you who know the UK, as Halifax, and as far south as Southend-on-Sea. Halifax is in Yorkshire, and very, very different types of property. We have conversion properties, permitted developments as they're known in the UK, that start from £65,000 to duplex 3-bedroom apartments at £450,000. So we can create a portfolio, or we can supply a property to suit someone's particular circumstances, and we've got the capacity to be very diverse in our recommendations and what we. I myself have worked for the company for full-time for 6 years, although I've known Joe Billingham for 15 years now. Previously, I had a background in wealth management, so my my knowledge of investment is quite diverse and comprehensive, in that I understand the nuances of equity investment and investing in pensions and other forms of savings. And the latest string to the bow that I've learned over the more recent time has been property. So I've got a good understanding of how people should build their asset base at different stages in their working lives in preparation for or inheritance or whatever it is that rocks their boat.
Great. Okay. Thanks, David. And yeah, thank you for that. Before we go into, I think, we'll just jump straight in with the sort of FAQs and a bit of a chit chat on sort of the current state of the UK market. Just before we go into that, can you give us a bit more info on that, sort of what makes you guys different from a sort of payment plan perspective and actually being able to fund these properties over 24 months? Because I believe it's you guys are the only people that will let overseas investors do that. Is that correct?
Absolutely. So the company was created, born out of the feeling that a number of people, particularly the expatriate community, were investing in savings plans. And I'm sure most of the audience will have had somebody knocking on their door convincing them to buy some equity-based arrangement. But they were buying opaquely charged products that weren't particularly good value. I think those products have become better over the last few years, but certainly 10 years ago they weren't attractive. And we community, or weren't being educated on the idea of investing in property as an alternative. And for those novice investors, which is what we targeted, we felt that if we could help somebody to accumulate their deposit over the period that we were converting a building, let's say over 18 months or 24 months, that would really be very attractive. So rather than getting somebody to buy a property that was finished and say, okay, we need 30% deposit today, we thought, how about pitching it that we would ask for 5% deposit today and then request that they pay the balance of a 30% deposit over the build period, which was invariably 18 to 24 months. So for the first time investor, perhaps with not a huge amount of capital to deploy or not enough confidence in the investment to deploy a large amount of capital up front, this gave somebody the opportunity to, on a £100,000 investment property, to pay a £5,000 deposit and £1,500 a month for 24 months to accumulate their deposit and get on the step ladder towards owning investment property. And we were pitching it very much as a savings plan linked to buying bricks and mortar. And I think today that still sets us apart from any of our competition in the UK. There's nobody else in the UK that does that. There are a few property companies in the Middle East that market property in the Middle East with that principle. But we like to think we were the pioneers of it, and it's actually been copied. I think one of the reasons it hasn't been copied in the UK is, of course, what it requires is a quite strong financial base for the developer itself to allow people to reserve a property with just a 5% deposit and then pay the balance in equal installments over an extended period. And that's something that we've been able to do because of the strength of our design of our funding and the senior debt providers that we have for each of our projects. Great,
thank you. Yeah, and I think that's a common question we get is why do you guys do it? Well, ultimately, it allows you to sell more of your units, doesn't it? Because it makes the property more accessible to a lot of people. So I think it's a great offering that you guys have got. So anyway, thank you for that. I just wanted to give people that are new to it a bit more of a sort of idea on how it works and why you do it. Let's jump straight in.
One of the other things, Callum, just to say, I think, is that we are very much a comprehensive provider of the whole service. So for somebody who's looking for a hands-off investment, the other thing that we do is we really do start from, obviously, the initial discussions in conjunction with introducers like APW and brokers who are specialists in the market. But once the client starts dealing with us, we're here to provide as much or as little support as possible. So if somebody simply wants to make an investment and then keep their hands off it completely, we will help them with obviously buying the property, the legal process, raising finance if finance is needed, the completion process, and then letting the property out itself. So within our group, we have a lettings agency that can manage the property for our investors. And that really means that you can keep away from it and just reap the rewards, hopefully, of the investment that you set about making 2 years previously.
So I would say, I know you guys deal with a lot of UK-based people as well, but it is very much designed for overseas expatriate people, isn't it? And it was born out of that idea of helping expatriate people get on the ladder, and the fact that you do all of that stuff that goes along with it, so you can be as involved or as uninvolved as you want, and you can be there every step of the way, or you can just pay your money and forget about it, which I think is what a lot of people do. And obviously you have the security of property versus the stock markets or whatever other options are out there. So thanks David. Let's have a little chat on the market and what things are doing at the moment, and where you guys see things going, what your expert opinion is. So can you just give us, to give you a very broad one to start with, can you just give us a bit of an overview on what you think, being on the ground there in Birmingham, one of the UK's top growth locations, what is the UK market doing at the moment? What's the feel, and where are things going? I mean, it's still a very strong market fundamentally, and things are growing. Is that still reflected where you guys are? I mean, what are you seeing over there?
I think completely frankly, we're all a bit surprised, I think, that with the resilience of the UK property market. I think when COVID-19 hit the UK back in early March, and then we went quickly into lockdown, I think our opinion was that the market would simply disintegrate for a period. And of course, we didn't know how long COVID. We'd have a solution by the middle of September, and then everything would be back to normal, but that hasn't turned out to be the case. From our point of view, what happened was we had 3 or so weeks of very little new business, and the lenders all shut their doors really to any new lending, and confidence was rocked. We saw a quite rapid increase in purchasing again, a lot of it from Hong Kong and the Far East. I think probably because things were worse over there than they were in the UK, or there was a flight to security in the UK, because I think we all know the UK is a safe haven, or as much of a safe haven as anywhere really, both from an investment perspective and also from a legal perspective. The framework of acquiring property is probably better here than anywhere else in the world, I think. So we've seen this uptick in business, and that has continued all the way through the summer. Obviously, our lockdown over here has been gradually reduced until recently, and we continue to rise. And that wasn't just new purchases or new reservations, it was also completions. The mortgage lenders came back into the market in June or so, and were more active than they had been for 6 months. And there's just generally been an increase in optimism. And we've also then found a number of domestic investors, i.e. UK-based investors, coming back into the market. So I think we mustn't get away from the fact that whilst the ravages of COVID worldwide are there for all of us to see, there still remains a large group of people, even if it's 10% of the world's population, who are incredibly well off, have got more disposable income and capital than they've ever had before, and have very few safe haven places to invest in at the moment. And I think that's what we're seeing, is people are saying, okay, well, what do I do with my money, and where is the safest place? And I think it's, at the moment, regarded as a safe bet that the UK is a good place. So we've been very positive, and we've had an interesting fall in demand over the last month. And I think that's because, particularly in Europe, there has been a mismanagement and a miscommunication of COVID. And I think we're all feeling around in the dark, aren't we, a little bit? But there's been a fall in confidence as we've gone back into these territorial lockdowns. And there's no doubt that the infection rate is very high again, but there isn't a corresponding increase in the number of deaths. And I think there's probably a practical feeling now that COVID's here to stay until there's a vaccine, but it's not having quite the impact that we all feared it might if we had a second wave, which it seems we are having. So the last week, for some peculiar reason, in fact, the last 2 weeks, we've been busier than we've been for 5 years in terms of new inquiries, new reservations, and so that's pre all the malarkey about Brexit. So I have to say, speaking personally, we're amazed that the market is so. Obviously, we're grateful and pleased at the same time. So.
Yeah, and we're seeing the same. We're seeing so much interest and so much demand for people wanting to buy in the UK at the moment. So, I suppose my question would be, put it to you guys, is what's driving that? Is it the fact that there's just a lot of pent up demand from the from the closing of the property market for a little while earlier in the year in the UK? Is it as if you read the papers, they'll be saying it's pent up demand from people wanting to move to bigger properties, or do you think it's the fact that we do actually have a fundamentally strong property market, and there's things like the stamp duty holiday and the low interest rates and all of that sort of stuff that are actually creating a good environment for the property market? So is it, I guess what I'm trying to say is it this short-term thing that's been driven by COVID, or is it actually we've still got a pretty fundamentally good market and it's a good time to be buying regardless of what's going on with COVID? What do you guys feel is driving it?
I think the UK property market in the long term still represents we mustn't get away from this. It's still regarded as a very sensible place to invest. I don't think it's expensive, or large parts of the UK are not expensive. We do have to point out that the London market is actually on its knees, and that's because it overheated a number of years ago.
Yeah.
And prices are still too high. And of course, in a backdrop and an economic environment of uncertainty, people are just going to stay away from London unless they're the oligarchs and the super rich who just want to live in Knightsbridge, and then they'll still buy and they'll look for bargains. But as an investment, I still think we've probably got some diminution in the value large part of the southeast. But our role as a property developer with a nationwide reach is to look for those pockets of value, and that's what we seek to do. So we don't have any projects in London, and no plans to have any projects in London, because we just don't see that the market is strong enough at the moment to support it. We'd love to be building something in London if we felt it was a good investment, but we just simply don't. But places like Birmingham and Halifax, for very, very different reasons, are both represent great opportunities. And that's because our perception, based on the research that we go into in each geographical location, is that there's every reason to assume that prices will rise, the demand for rental properties will rise, and therefore, accordingly, if you have a property there that's invested, that you've invested in, it will do very well over the next 5 years plus. Certainly, we're not in property and selling property for short-term gains. We don't try to entice people to buy our properties based on the fact that they're going to have the most fantastic capital appreciation. It happens, and it has happened over the last few years in certain places, but we're just here to work on convincing people that what they should do is deploy their capital into a property, and if they could generate a yield of 5% per annum, 6% per annum, then over the long term, that will hold them in very good stead and will benefit them.
We were actually having this conversation with someone earlier this week. You know, you could spend a year looking at 50 different properties, looking for the perfect opportunity that's going to get the most capital appreciation. Whereas in reality, if you went for somewhere that ticked most of the boxes and was pretty much there, you'd have a year's worth of rental income in your bank by the time you found that perfect property, or potentially didn't find it, you know. So I think, you know, just being smart and looking at areas like you say, you know, it doesn't have to be London, but looking at areas that have strong fundamentals, and you can't go far wrong. Anyway, just to keep it on COVID for a little while, we've got a few questions coming in, David, just to the people that have put those in. We'll do those at the end, guys, if that's okay. We'll just get through some of the stuff that we've been sent in by a lot of our clients this week. So just keeping on the COVID theme, how do you think, if at all, I know you said you look at places on a 5-year time frame, you know, and if you look at any reports by Savills, Knight Frank at the moment, you know, they've all still got, I think their October report had places like the Northwest, the Northeast, and parts of the Midlands rising by 24 to 28% over 5 years. So they're obviously confident, they know what they're talking about. But what do you guys think? Will COVID change the future outlook of the property market? You know, one of the biggest questions I'd say we're getting at the moment is, well, why would I want to buy a city centre flat, albeit in the heart of Birmingham, lovely development from prosperity, when, you know, everyone is leaving the city because they're going to work from home and no one's going to work in the city centres anymore, and everyone's going to bigger houses with gardens. Is that a long-term thing we're seeing, or is that, you know, just you know, what is that? Is that here to stay? Is it just the people that can afford to move to bigger houses in the country can do that? You know, what is that? What are you guys seeing from that?
I think out of that question, there are two distinct things. One is we must differentiate between the wealthy again and the well-to-do people who might well be seeking to go and live in the countryside for the reasons that we understand as a result of COVID and just quality of life and getting out of the rat race. And they're bound to do that. And I think that will happen. Yeah. If somebody's got the capacity to do it, then I think they will. But the typical tenant investment in the centre of Nottingham or Birmingham hasn't got that choice, actually. Even if they're quite well-to-do professionals who might have a salary of 35 or 40,000 a year, they still have to go to work. And actually what they want to do is to simplify the whole process of getting to work. And at the moment, for sure, you know, we've got KPMG's new offices here, which were the most super. They wouldn't be out of place in Singapore, and they're about 500 yards from my office. And they were opened in great pomp and circumstance in February with, you know, 2,600 people there. And I understand at the moment there are 800 people working there. You know, so KPMG must be wondering what on earth have we done. But I think that is short-lived. And yes, people are working from home at the moment, and there's all the reasons for it being beneficial to work from home. But I suspect that most of us who are still working, who are in the audience today, will have had some experience, whether it was 1 month, 3 months, 6 months of working from home. And there are some merits, but there are also some significant demerits. And I'm sure some of our relationships have been tainted a little bit from being under the feet of our respective partners. And there is a pent-up desire to get back into the office. There's a need for the human being to socialize and to interact. I have no, you know, we are back in the office now and have been since May. And there's no doubt that the stimulus of people working in the same office regularly, and undoubtedly helps the enterprise of the business and the effectiveness of it. And whilst more senior people can work remotely and use Zoom to contact their clients and their connections, I think the rank and file in an office environment actually need to be in an office and need to be told what to do, and the employers want to have that control over them. So as soon as this is over, we will quickly forget all the advantages of home working, and there'll be a rush to get back into the office, to have that social interaction, to become more efficient, and to be able to simply go and have a beer in the pub at 5:30 with your friends. And I think that's all that's missing at the moment. So yes, there's a hiatus in the property market from a temporary point of view, because I think yes, fewer people probably are demanding property in city centres to then go to work the following day. But I do really think it's only temporary, and we'll rapidly see that changing once Birmingham, which is a market I know particularly well, and we have a number of properties already in the marketplace, is a very strong rental market still. And one of our projects that we completed 2 years ago with 60 apartments, I know specifically yesterday, is 100% let. So, I think that shows you that, these people are still wanting to live in a city centre. Even if they aren't going to their office at the moment, they still want to be in a city centre for all the advantages that it affords them if they don't have a huge amount of surplus income or capital. So, long may it continue.
Yeah, I think you're right. And if you do sort of reading around the subject at the moment, a lot of the research houses are of the same opinion. It's a shorter term shift, and people do tend to forget things very quickly, don't they? And I think we'll be back to traveling on planes and doing all of that sort of stuff as soon as we're allowed to. Anyway, David, so moving on from the COVID stuff, Brexit, everyone's next favorite. What if we don't get deals with the EU in place come the end of December? What's your take on that, and what would you say to people that are worrying about Brexit? I mean, it's been a worry now for people since the referendum 4 years ago. It seems to be on a lot of people's minds all the time, and it's hampering a lot of decisions. If you'd bought 4 years ago when we had the referendum, then you'd have 4 years worth of income in your bank, and property prices would have gone up an awful lot. So I think it's never a good time to buy, and it's never a bad time to buy. But never the perfect time to buy. What would you say to people? Or what are your comments on Brexit? How do you see that affecting things, if at all?
I think clearly it is going to affect, but I don't really believe I know. I can make my personal comments known to the audience, but I don't believe any of us really know what the impact of Brexit will end up being 5 years down the road. There are a number of very clever economists who are putting their views forward, and some of those are positive, and I think more of them are negative than positive. But there's a huge divergence between these great intellects over what they think will happen, and I think that shows how complex it is to judge. And of course, the overlay of COVID-19 on it makes it even more complex. From my point of view, the UK economy, just looking in as an interested businessman, is quite buoyant given what's going on, and certainly I know is that things are better here than they are in a number of the other states in Europe. So I think it's difficult to get too into the discussion because it almost becomes political, doesn't it? But I don't think I was ever particularly anxious about the fact that we were going to get out of Europe. I still think that the UK has an enormous amount to offer the world in terms of its product and its services. I think we're market leaders in a number of different things. I think the overall opinion about the UK as an economy has actually been overstated, and that's been reflected in a reduction in the value of sterling worldwide. And I actually think it's way overdone over the next 5 years. And that must be, very comforting for anyone who's living in Singapore or Hong Kong, looking to invest into the UK market and convert their currency that they're paid in or that they have their savings in into sterling, because I think that will augment the value of the capital investment they make in property. So it's a good time to buy, I would say, for anyone who's overseas.
Yeah, it's a good buying opportunity for sure. And would you say, I mean, my opinion or understanding would be that sort of London, with anything with Brexit, London would be one of the worst affected areas, because it's influenced more by sort of, external investment places that we're looking at, or where you guys are developing property, such as Birmingham, Nottingham, further north. I think these places, and forgive me if I'm wrong, they're very much more internally driven by internal demand.
Yes.
So I would say perhaps all the stuff you guys are building and doing is better placed, and it's not going to be impacted by as much by any negative impact of Brexit, I think, because the very nature of the stock you're building.
Yeah, I think absolutely, and that goes back to the need for a property developer to diversify and to look at the marketplace generally and to seek value. And yes, that's definitely what we try to do.
There we go. Then that's a good on to another question I had for you, which is, how are these changes in the market and the different things we're seeing happening now impacting on the types of property you guys are building or looking at building? Has it changed anything at all? Has it changed the areas you're looking at or the type of property you're looking at? Can you tell us a bit more on that?
We still fundamentally have great confidence in.
Hey, Joe.
Oh, hi.
Good to see you.
Sorry, in the conference, you know that, eh? Oh, yeah.
Hi guys, this is Joe Billingham. He is the CEO.
Josie, as I've been talking for half an hour.
Yeah, you've come right at the end, Joe. Perfect timing.
Oh, okay.
Yeah.
Sorry about that.
Okay, how are you?
I'm good, thank you. I've been stuck in rather bad traffic this morning. There was a car on fire on the motorway.
That's Birmingham in a nutshell.
So.
No, I don't think it had been set on fire.
No, it was an electric fire by all accounts.
Oh, there we go.
Obviously delayed me somewhat.
Good. Well, we were just.
I'll answer that question rather than have you ask it again.
Okay.
Yeah. So we continue to have great confidence in Birmingham for all the reasons that I've alluded to. I agree, going back to London, that London has got a more of an issue than any other part of the UK because of its pricing, but also because some of the services that are provided in central London post-Brexit might well be affected by competition in Frankfurt or somewhere where banks maybe want to locate their offices and the stock market becomes stronger. UK will remain popular, and the UK stock market will still be one of the 4 best stock markets in the world to transact and trade. And the other interesting point, of course, is HSBC have relocated a great big office facility with over 3,000 people into the centre of Birmingham. So why would they have done that if they were particularly concerned about Brexit? I think it all augurs well for the future. In terms of our market, we continue to seek value in places where the macroeconomic climate and the regional advantages seem to manifest themselves into convincing us that it's a good place to invest. So anywhere where there's a new hospital, new rail links like HS2 in Birmingham, new airport, any of those events instill a confidence in a community, which leads to a growth in the infrastructure. So we're always looking for that type of opportunity. One of the things that we are definitely seeing, despite the fact that I said that the people who are going out to seek property and live in property in green rolling fields and countryside, I still think that there is an interest in doing that, particularly for young families. And so we have focused on a new opportunity that we see for building starter homes and projects out in the countryside. And we will be launching a project in the not too distant future, which is focused on building houses for young people as starter homes, or for young people who haven't got the capacity to invest as properties to rent. And there are great opportunities there for some of your clients to support that clear and distinct change, I think, in people's aspirations, particularly young families, as they seek to look for a bit of space and somewhere for the children to go and ride their bikes, etc., etc.
Very exciting. Sure. Yeah, I think that's a...
May want to add to that now.
Yeah, I think it's kind of, very much, as David touched on, the market in Birmingham is more and more so young professionals. So, we touched on the London point, it's still a 40% saving for an employer to have the same person in effect doing the same job based on a desk in Birmingham, than it is in London. So, there's still a huge saving there, and employers are still capitalising on that saving, and that's what's driving the employment boom in Birmingham. That type of professional, we've got guys in our own office that, live and work in the city, and that, they wouldn't want to live and work anywhere else. But yeah, I think, certainly, as a developer, expanding out of, we've done, as a lot of PDR sort of conversion works, where there was an opportunity in the market there with the relaxed planning laws. And then obviously we've got a big focus on strategically on land banking Birmingham, which will be here for the foreseeable future. We've got a substantial amount of units both in production as well as in planning. So across the whole sphere of sort of the development process there for Birmingham. But we're always looking for new opportunities, and certainly housing is something that we've looked to move into for quite a while. Difficult to find the right type of housing sites where there's an opportunity both for local housing for local people as owner occupiers, but also them be at a price point that make it work for an investor. So certainly, the locations we've chosen, they've got good drivers for appreciation, but they're still showing, healthy yields.
Very exciting, and I think that's great. Giving people the opportunity to get involved in a freehold property from overseas. On that monthly plan we were talking about earlier, David. I think it's very exciting. And Joe, you said there, you were looking at capital appreciation. And that was sort of one of the questions I had or wanted to ask on behalf of our clients, and ones that we get asked quite a lot. Where at the moment, if you're looking for the holy grail of, maybe you can't answer it, maybe it's very difficult to say where the holy grail is. I mean, we were just saying earlier, David, the perfect property often doesn't really exist. You've just got to look at the fundamentals. But where would you say, from a capital appreciation perspective and a yield perspective, where are the best sort of places to be looking at the moment? Are they around the HS2 lines? Are they at these freehold houses with the shift in the way people are looking to live? What are the opportunities that we're looking at over the next 6 and 12 months?
Sure, housing, has always done well. I think it's the kind of pyramid effect of the sort of the requirement for housing. So if you kind of again, if you look at, I suppose, from a simple, maybe if you look at sort of 1 beds versus 2 beds, and when it comes to apartments, 1 beds outperform 2 beds on a yield perspective. You'll get more pound per square foot yield out of 1 bed, just because the base price of rental is the marginal difference the purchase price of a 2-bed versus a 1-bed on a pure yield basis. But then if you look at the curve, the growth curve of appreciation, a 2-bed will outperform a 1-bed in appreciation terms over the long term. So there's a point where the return on a 2-bed outperforms in capital terms both the appreciation and the yield of a 1-bed as a total return.
Okay.
And that's pretty similar with housing across the board, really. So if you look at the most in-demand housing in the UK, it's somewhere between a sort of 3-bed, statistically it's like a 3.6 bedroom property. So obviously that doesn't exist. So that, somewhere between a 3 and a 4-bed. So if you imagine kind of, ultimately long term, there is going to be more demand for 3 and 4 bedroom houses. And that's the challenge because appreciation wise, long term, they will outperform the smaller units in the market. But then in the short term, or at least overall term, they'll always the smaller units will always outperform on a pure yield perspective. So I think it's it's about having a sort of a mixed view if you're able to invest across multiple units.
Yeah.
Locations wise, David's probably touched on. We're very pro Birmingham, obviously Birmingham born and bred. Very pro Birmingham, but fundamentally and sort of that aside, it's in a sweet spot because it still provides strong yields whilst you've got the capital appreciation play. So that's why we love Birmingham. But sure, it's as you achieve a better yield, the likelihood is you will achieve a lower capital return in appreciation terms. So if you from the extreme of all the way up north where you could buy a kind of a 2-bedroom terrace for £50,000 and probably get a 10% yield, down to the sort of the very select parts of London that you'll buy at multi-million pounds and probably struggle to get a 2% yield. So. And the reason why people like those different markets is because they offer different things. I think it's good to have a bit of a mix. It's good to have a kind of compromised view. So somewhere in the middle is understanding, obviously from your perspective, the work that you do with your clients, understanding what their objectives are, understanding what they're looking to achieve, short and long term, and then building a portfolio that does that job really.
Yeah, and I think that's the key, actually, isn't it? Is defining what you are trying to achieve. What you basically explained there or helped us sort of see is that different properties will do different things for you, right? So don't just come into it and just buy one because you think it's going to be the best. You need to look at, well, do I want income? Do I want yield now? Or do I want more capital appreciation and income further down the line? So I think it's important, to distinguish what you are actually looking for.
Yeah. I think even more so now because with the internet and with I think some investors very much do want to invest in property, do want to buy maybe their first property or multiple properties. You can get this kind of almost information overload, can't you? There's so much out there, there's so much sort of opportunities tendering for the investors. Hard-earned money that you have to kind of almost. I think that's just from an investor perspective, just kind of almost take a step back and really decide, what is it they're looking to achieve, really.
Yeah, and I think that does help narrow things down. You'll clear a lot of that background noise out. Once you know exactly what it is you're looking for, you'll say, well, if I'm looking for a 7-8% yield and I want that income now, then I know I should be looking from this town and further north, or these sorts of places. So it will help narrow things down. Just on a sort of helping people buy perspective, guys, what is it? Is there anything you guys are doing, in terms of deals or incentives, or obviously aside from the 24-month and the sort of monthly savings approach, is there anything else you guys are doing that is sort of helping and encouraging people to get their foot on the ladder at the moment?
Yeah, there is. I think, and part of that, like all the kind of house builders, We all have a sort of a bit of a push come the end of the year if our accounting year is January to December.
Yeah.
So we do
very honest of you, Joe,
to close business. Well, I think we're certainly looking to close business at this time of year.
Sure.
And obviously on the back of that, I've brought out we've launched early our first time buyer offering, which allows, although our typical investor deposit is 30% for first time buyers, or the people buying their first home in the UK. We will do a 15% deposit, so an incentive of sorts, but certainly it makes it a lot more affordable. So we can pretty much halve deposits on a lot of projects at the moment on the basis that it's their first purchase. So that makes the whole thing a lot more affordable on a monthly basis. And then for investors, we've got what we call some investor bundles, which on JQR Birmingham development, we're going to run just for a few weeks and for not limited plot numbers. They can choose whatever plot they like, but for limited amount of units. Yep. We've got around 20 of these plots, and I think we're about halfway through them.
Yeah, we are. And your audience, that's only available through what we would describe as platinum type introducers. So it's not open in the available in the open market. So APW, incidentally, is regarded as one of those.
Great. Well, that moves us into we're coming to the end now, guys, which is good. We've done a good job, actually. We've covered off a lot, and Joe, I'll ask you if that's okay, just before we go at the end, just if you could give us a little bit of background on yourself for those lovely people that are listening and would like to sort of get an idea of who you are and what your background in property is and all that sort of stuff. But one of the questions we've got here from someone is, what type of monthly investments are typical of this approach? Can we have an idea of the range, please? Also, what is the typical value of the property? So, as David touched on earlier, guys, it's from 60,000 to 400,000. Then your monthlies can be anything from 900 up to 2,000 or 3,000. But I think I'll pass it over to you guys just to maybe, if you give us an example, say of a standard £100,000 unit, say like a Chesterfield or a Nottingham, and then maybe a JQ Rise, for example, just so we can have a little.
So we've got. Sure. So just to give you examples, I suppose, the three types of developments that we've touched on today. You've got the sort of the high yielding one bedroom apartments or two bedrooms for that matter, but in sort of places like Nottingham. So still, key drivers there. We've got those starting from I think around 107,000 with parking. Bring in monthlies of circa £1,000 a month. Certainly we can work on those sort of terms. Your JQR starting point is 199,950 up to 450,000. So then there's a range there of sort of 1,1800s up to, as Callum suggested, £2,000 or £3,000 a month. And then the houses will be coming in. Starting prices there about 159, and again going up to sort of late 300s. So again, sort of spectrum. The payment plan, that ultimately works for for the investor. And so we can look to reduce monthly amounts and sort of with a couple of lump sum deposits in there, or sort of extend terms, but we're pretty flexible.
Yeah, hopefully, Callum, you can convey to your clients and potential clients that we are quite malleable, flexible in terms of if somebody's really interested in buying one of our properties, we will try to accommodate their payment profile as best we can.
Yeah, for sure. And I was going to say there, I think those are your guidelines, right? Because they work for a lot of people, but that's one thing we know from working with you guys for such a long time. And one of the reasons we love working with you and why our clients love working with you is because you are flexible and you do help us put deals together that, other developers and other people may not help us do. So So anonymous attendee, whoever you are, whoever asked the question, there are, if you've got something specific you'd like to look at, then have a chat with us, and we can have a chat with the guys in Prosperity and see what we can do. Next question, guys, which has come from someone in the audience, and other questions we've pretty much covered off in our original watch chat up to now. So we'll ask this one. If there's anyone else who's got anything, please ask away now, and then I think we'll leave it there because we've been going almost an hour, which is great. So if you invest in this approach, the 24-month thing, and for example, you've been investing for 18 months and you have 6 months left, but then you get made redundant and cannot pay anymore, what happens then? Do you lose all the money? What's your fee? And then something I would add to that, guys, is can you give us an idea of the sort of security that's around it as well? How are people secured, and how are the funds secured, and what happens if you guys were to go bust, if that, would happen, if it could happen.
Okay. Well, I think I'll cover off the kind of probably well, they're both prevalent questions, but I'll cover the most serious scenario off first. So from a financial structure perspective, as all large developers, and sort of the PLC model is very much you have a top which deals with all sort of sales transactions, all the sort of day-to-day administration of the business. But each individual development is ring-fenced within what we call an SPV, so it's a standalone company that holds that asset. When you buy from that particular company, you'll be buying, exchanging contracts. You have a unilateral notice, so your deposit is safeguarded. Well, I think in 3 ways. One, it's safeguarded on the basis that you've got a contractual position, and then we can kind of go into how we protect that from a contractor perspective, because the reality is that once we've bought the site and run it through planning and you're exchanging contracts, the real risk here is a contractor risk, which we mitigate by way of step over rights within the contract, which means that if the contractor was to fall over, we would step over them. And all our contractors are bonded. So we have an Aviva bond which wraps the contractor, which basically means that if the contractor was to fail, they could bring in a second between the cost of contractor A and the cost of contractor B. So I think from a contractual exchange perspective, once you've got your unit exchange, which we try and do in 28 days, we can prove to you through lots and lots of due diligence, which I won't go into now, but certainly we could provide, and then your lawyer can obviously do their due diligence to the protection of your monies. Secondly, I think the fact that our developments, different to some off-plan sellers, are the fact that we don't require sales, so they're advantageous to us, but again, we can show how the schemes are funded. So once we launch a site, once we launch a development, we don't require those sales to build the site. So whereas we're not directly utilising, there is a utilisation of the client funds, but it's not against the development in its purest form. We're not expecting the deposits to come in, so we can show you that any development from the start. So there is a advantageous use of the deposits, which is why we do what we do and can offer the sort of levels of discounts that we do, but they're not intrinsic into the funding of the deal. So I'm going to be concerned that 50% of it's sold, and we need the balance sold before we can complete the project. Yeah. And thirdly, all of our developments come with an NHBC or equivalent warranty. We used to use Zurich a lot. We now use Build Zone.
And sorry, Joe, just for the
but all of those come with a 10%.
Sorry, just for the newbie such as myself, what is a NHBC 10-year warranty?
Well, a 10-year warranty that covers the fundamentals of the building, so it's the fabric of the building. We give warranties, internal warranties for the internal appliances and anything that's in the building. But the 10-year NHBC warranty is your kind of all bells and whistles, belt and braces warranty that your lender would need. So from a CML perspective, from a mortgage perspective,
yeah,
warranty, and that's either with NHBC or equivalent. And within that, you get a 10% guarantee. And I think the fact that the clients pay monthly They can go on the website. They've got our monthly updates. We will be in touch with them at least every quarter, giving them updates. So the deposit, we don't ask for the deposit up front. So they're getting to drip feed the deposit. And whilst they're drip feeding the deposit, they're seeing their building come out of the ground.
Yeah, and I think it's again, it's a great way of doing it. I mean, I was speaking to someone earlier today, and we were saying, it's all very well trying to save off your own back, but if you guys are, anything like me and other people living overseas, then, well, prior to COVID anyway, you would tend to go away on nice holidays and spend your money on things that perhaps weren't as good for you long term as buying a property. But I think with this approach, at least it's structured, and you're paying yourself first in a way, ensuring that you are putting something towards your future or towards a property, which is a good thing to do. Just on the example of if someone was funding a development and they'd lost their job a couple of months before the end or 6 months from the end, what can we do there? I appreciate from your guys' perspective, there's contracts in place, but you will. I mean, my experience has been that you will always try and find a positive way out for people, and you'll try and find something that will help them.
Yeah, I think. Sure. I think, again, just touching on the kind of, the world we live in and the transparency from the point of view of you can go online, you can check companies out. I think, in reference to the first point, if you look at our track record from delivery of apartments and we've been doing it many, many years and we've built and delivered many, many homes across the UK. So I think, looking at that background and looking at that track record is obviously sort of, should provide some comfort for point A. And point B, again, if we were penalising clients or people were kind of, yes, people do lose their jobs, people get divorced, people have change of circumstances in lots of different ways that mean that financially they commit to something. Now, as Callum referenced, there's a contractual position, and that's just the standard stuff really, but, I can assure you that we work with clients. We've invariably moved clients from one development to another development, i.e. that allows that client then to get a prolonged amount of time to sort of, sort themselves out and then come back online with maintain their payments, maybe on a different development that completes a year later or 6 months later, but that's something that works for them. We've also moved clients to our VPP funding, whereby at a certain point, typically about 70 fund, we do have funding available where we give developer funding. So we do look at that sometimes, where we stepped in at the last minute and sort of funded it from a developer perspective, and then took an attachment of the rental. But all these things are, they're not sort of standard stuff, and certainly, many sort of, another PLC, put it that way, where basically you don't complete on the Friday and you've lost all your money by the Saturday morning. It's kind of, one, work with clients. We don't want to take anyone out of a contract. We want to get them over the line and work with them. But then if that's not possible financially for the client, then we'll work with them.
Yeah, thank you. And I would say, that is one of the benefits of working with you guys. As we get to do this, we get to meet you, David, meet you, Joe, and we can have these discussions, and obviously prior to COVID, you guys would come out and visit us and meet our clients in Singapore and Hong Kong, and you have got that personal touch, and you have got a line into you guys, if there's anything you need to discuss or these sorts of things. So the personal touch does help. And I think we'll leave it there if that's okay, guys. We've been over an hour now. Joe, would you mind just giving us a little bit of background on yourself, or just giving a bit more info for the people that are listening and would like to know more about the man behind the business?
Sure. Started out with a business that allowed me to start investing in buy-to-let. So that was actually a sandwich business.
I didn't know that.
So we used to run sandwich vans that obviously, going back to kind of, in 18. And they used to generate, they were good sandwiches. And they used to generate enough money for me to start buying buy-to-let properties. So I used to save, obviously, and generate enough for a deposit. And then I started working a lot with the deceased estates. So I used to do a lot of probate work. And that was really kind of my forte early on, where I would source and work with solicitors primarily with their probate work, and got to a point where there were more properties being offered to me at advantageous prices than I could buy myself. So then I used to trade those contracts and sort of look to introduce clients. And then so it became a kind of more of a property business, working with clients as well as refurbishing properties. So some I would refurb and keep, some I would refurb and sell. So it was a kind of a, very much a sort of, the traditional model. That developed as a business to a point where I needed more stock. So I started working with the PLCs and buying their kind of end of line. So very much at time of year like this, but they used to sort of need to clear stock quite aggressively at certain points in the year. So we used to sort of buy en masse, sort of little schemes or sort of end of line apartments or whatnot. And then I did a small development in Birmingham, and then the appetite for the client bank then was very much wanting to buy offshore. So I went to Cyprus, developed in Cyprus for 5 years. I'll try and get through this as quickly as possible.
That's okay. It's a good kind of,
so 5 years on kind of takes us, somewhere near to. So it's good, sort of Cyprus and Greece. Did over 1,000 units there over a sort of a 5-year period. This brings us up to the recession, and obviously then that was a kind of a flick of the switch, and that sort of lots of things changed overnight. So luck rather than judgment, we were out of pretty much all the sites that we were working on at the time. Still got a couple of pieces of land there, but we've not chosen to develop them out since. But it was very much the clients were an investment angle, but on the basis they were rented out, but for holiday homes, very much sort of second homes at that point.
Yeah.
Post recession, working with David, we were sort of setting up a sort of a small fund, which was really looking to buy distressed assets out of West Register, which was the toxic arm of RBS, and they were looking to sell down assets that they'd taken off other developers and sort of portfolios of houses. So we kind of rolled our sleeves up and got involved in those. So they were a mix really of portfolio of terraced houses in different parts of the country, up to working then with ALB on a lace mill. That was a conversion there, and that was out of West Register as well. Yeah. So then we were, the clients that we were working with, they weren't particularly interested in investing through the fund. They did want to invest in the underlying sort of assets. So,
sure.
Then we sort of then were fully born back to developing again. And then our first sort of developments there were going back sort of 9 years ago. 9 years ago, we're kind of 30, 40 unit apartment schemes, and then to take us to where we are now, our largest applications, 644 units in the centre of Birmingham.
That's great.
Lots in between. So.
Wonderful. That's really interesting. I didn't know that about the sandwiches, Joe. Did you have like a special sandwich that you were known for, like a tuna? Sorry.
It was Joe's sandwich selection, and then it morphed into Joe's buffet selection.
Much like now, you have a great selection of things for anyone, whether it's capital appreciation, yield, high price point, low price point, whatever you're looking for, guys.
Exactly. I used to run a tab for people, so I tried to make it affordable.
Hey, so good business practice started early on, and you're still doing it. Yeah, I think we'll leave it there, guys, if that's okay. David, thanks very much. Joe, thanks very much, guys. Obviously, really appreciate your time as always.
Thank you. And apologies again for my timing today.
No worries at all. And I know people love to hear from you guys, and everyone that's listened in will appreciate that, and we'll send it out to everyone as well. And good luck with your talk later today as well.
Thank you. Thank you.
Awesome. Thanks, guys.
Bye.
Bye-bye.
Take care.